Hello, everyone, and welcome to our webinar, Israel's Financial Firepower 1 Year Later. We are thrilled to have you with us today. Over the next hour, Brian Friedman will lead this session, followed by a Q&A. For those new to our webinars, Brian has over 30 years of portfolio management experience and is co-founder and president of GHP Investment Advisors, which oversees more than $2.8 billion in assets. He also brings a deep understanding of Israel's investment landscape. Feel free to drop questions in the chat or the Q&A box at any time, and we'll address them at the end. For those of you who are not familiar with Israel Investment Advisors, our company was established in 2010. IIA is the general partner of the Israel Investment Fund, LP, an actively managed Israeli stock portfolio focused on long-term growth. We invest in profitable companies with strong balance sheets and reasonable valuations. We are focused on Israel as a scale-up nation, not just the startup nation. We provide ongoing research, consulting, and advisory into the Israeli economy and the investment landscape there. Brian Friedman is our Chief Investment Officer and Portfolio Manager. And with that, let's get started. Brian, the floor is yours.
The chart that you have in front of you was put out by the IDF 1 year ago as an explainer of the offensive in Gaza that they had just launched a few weeks earlier. They were trying to explain that the time had come for a major shift in the strategic reality in Israel. It had not yet fully evolved. The conflict had not fully evolved into the seven-front war that Israel has been fighting since 1 year ago. But nonetheless, it's striking to me that the very last sentence on this presentation, despite the fits and starts, the controversy, everything surrounding the war, is still descriptive of what the goals were and still are. The October massacre has made it clear that the strategic reality must be changed and the threat to Israel be removed. Within that context, we can now view with hindsight what has been accomplished, but from our vantage point, what it took, the resources required to get to where we are now. I want to start with the population growth in the state of Israel. Why do I want to start there? Because much of the strategic reality facing Israel prior to October 7th, 2023, was an encirclement campaign called the Ring of Fire by Israelis and by the Iranians to not to defeat Israel in one single blow. It seems to me, and it seems to many of the strategic thinkers that I've read, that the Iranians' goal was to wage a long-term war of attrition in order to diminish the quality of life in Israel and encourage Israelis to leave from their vantage point. So first of all, I think it's notable that over the last year, the Israeli population has grown from 9.8 million to a little bit more than 9.9 million. So in the sense that the primary objective of Iran and its allies is to degrade life in Israel and force Israelis to leave en masse, they did not succeed. However, if we look at the rate of population growth in the prior 20 years, from 2003 to 2023, the Israeli population grew by 2% per year. And that was a combination of natural increase in terms of the birth rate, but also a fairly large net inflow of new immigrants. What has occurred over the last year is a 1% rate of population growth. So unfortunately, even though Iran clearly did not succeed in its biggest objectives, there was an impact. And if you break down population growth over the last year, the birth rate remained the same, but the net migration rate fell dramatically. Far fewer immigrants moved to Israel. And in fact, there were some Israelis that moved out. There was still a net inflow in terms of immigration, but a very small inflow. So even though Iran clearly did not succeed and will not succeed over the long run, over the last year, Israel experienced its slowest rate of population growth in the last 20 years. Another aspect of this conflict that we noted 1 year ago was that Israel entered this war with a very low level of government debt. If we look at the trend in government debt as a percentage of GDP, Israel went from a fairly indebted, somewhat economic basket case in the 1980s to one of the most fiscally conservative countries in the world on the eve of the war. Before October 7, 2023, the Israeli debt to GDP ratio was 60%, more than 20 percentage points lower than the United States at the time. Since then, the debt to GDP ratio in the United States has gone up to 100%, but the Israeli debt to GDP ratio at the end of 2023 had only ticked up to about 64%. And like I said, we don't yet have final numbers for this year, but most likely the debt to GDP ratio in Israel will be somewhere in the neighborhood of 70 to 75%. Just to put that into perspective, that is still lower than the US debt to GDP ratio by 25 percentage points and lower than the Israeli debt to GDP ratio back during the Second Intifada and even the 2006 Second Lebanon War. So even though there has been a substantial increase in debt to fight this war, Israel nonetheless still remains one of the least indebted developed countries on the planet Earth, even after the last 14 months of intense combat and expensive defense. Now that's further reflected in the Israeli government budget deficit. To put things into perspective, over the course of the last 20 years, the Israeli budget deficit has tended to be a little bit less than the rate of economic growth. Economic growth in Israel has averaged 4% a year for 25 years on average, and the deficit has tended to be a little bit less than 4% for most of those years, with the exception of COVID in 2020, when Israel, like the United States and other countries, borrowed quite a bit of money and spent quite a bit of money when they closed much of the economy due to social distancing restrictions, etc. So it might be notable. I want to note that despite the war, the deficit as a percentage of GDP at the moment is still lower than it was at its peak during the early days of COVID. Nonetheless, this period of time is sustained for a much longer period of time. And so this deficit will probably persist for several years, depending on the nature and the course of the war and the reconstruction after the war ends. The other side of that coin is Israeli government spending. Once again, if we look at the COVID spike in 2020, we have not seen Israeli government expenditures yet exceed what was spent during COVID. Why do I keep referencing COVID? Because I want to put things into perspective. Israel has faced a very difficult economic challenge, a very significant increase in government spending, particularly for the military. But despite that significant increase, it's still not as significant as was required in 2020 at the height of COVID. So government spending is not only lower than the COVID peak, it is, despite that significant increase, just takes us back to what the government spent on average in the years preceding the Second Lebanon War. This is where I want to emphasize Israel's fiscal conservatism in the decades leading up to the war is paying very significant dividends for the state of Israel today, allowing Israel to foot the bill. Not that they like to foot the bill with higher taxes, bigger deficits, and more spending, but they were ready to foot the bill. And so far, despite the significant increase in spending required, it is well within the capacity of the state of Israel to handle. Many people are making a comparison, excuse me, to the 1973 war, and rightly so, because like the 1973 war, Israel was caught by surprise. It faced a sudden challenge that it was not fully prepared for in the early days of that war, just as it wasn't fully prepared for what faced it in the early days after October 7th. But there are the analogy with the 1973 war, I think, does not hold water from an economic and financial point of view. Let me just give a little bit of a tour of the region to explain why I think there is a very significant difference today versus 1973. The chart that you see before you shows you some of the data of Israel and all of its neighbors on the eve of the war. Just prior to October 7th, Israeli gross domestic product was $525 billion, and the population was 9.7 million. In 1973, Israel was a country of 3 million people with a GDP of only $30 billion. A vastly poorer country with a GDP per capita adjusted for inflation back then of only $6,000 per person versus $54,000 today. The military today, on the eve of the war, the military budget in Israel was $23 billion. That has, we'll get a little deeper into it, but that has increased by more than 50% in the last 12 months. One of the striking things to me, anyway, about what has transpired over the last year is the misjudgments that everyone has made, including Israel, regarding the strength and power of their enemies. The United States and Israel probably overestimated the strength of Hezbollah, overestimated the strength of Iran, and those countries vastly underestimated the strength of Israel. There has been surprises all around over the last year. But what is particularly interesting to me is, had we just looked at this table of gross domestic product per capita 1 year ago, that has probably proven to be the best indicator of what the power relationships truly are. What do I mean by that? Let's just take Syria for a minute. Syria had a GDP of only $11 billion. Well, that's because the Syrian currency collapsed, the economy collapsed. It was in a state of what we thought was frozen conflict, and the GDP per capita had shrunk to less than $1,000 per person. Perhaps we should not have been quite as surprised once Israel removed Hezbollah from the scene and revealed Iran's weakness, that the Syrian army would disappear overnight, because how could the regime pay for them with no economic resources at their disposal? Number two, if we look at how the conflict has evolved over the last year, the stunning superiority of Israel's aerial defense and its intelligence, both of which are extremely expensive assets, had proven to be decisive in this conflict. And if you look at the various adversaries, including Iran, with a GDP per capita of only $4,400 per person, you have to ask the question, how could they possibly afford either the aerial defense that they need or the assets to project their power like they claim they could in terms of missiles and aircraft? This is not to say that GDP per capita is determinative. I am merely trying to note that if we looked at this lineup of Israel's vast, overwhelming superiority in economic power, it ultimately played, I would argue, the decisive role in military conflict. Not that that conflict is over by any stretch of the imagination, but it has shown the vast differentials between Israel's capabilities and its enemies' capabilities. Another comparison with the 1973 war and its aftermath is the military expenditures as a percentage of GDP. Well, in 1973, Israel fought a very large multi-front war, but it had a much smaller economy and it had severe economic problems. At the peak, in that war and just following the war, defense spending was more than 30% of GDP. You might remember the chart I just showed you a few minutes ago that showed that total government spending in Israel today, not just military spending, total spending, is about the same as that same 30% of GDP as military spending was back in 1973. Today, at the end of 2023, Israel spent about 5.3% of its GDP on the military. Now, that was a significant uptick of the 4.5% it spent in the prior year. And that, of course, only includes the first roughly 3 months of the conflict. We don't know yet the final numbers, but most likely defense total military spending as a percentage of GDP is in the neighborhood of 7 to 9% at the moment. A very significant increase. That would put Israel at the top of all developed countries in terms of defense spending as a percentage of GDP, and about 2.5 times larger in economic terms than what the United States currently spends. So I do not want to minimize how costly this war has been. What I do want to do is put it into perspective. Israel walked out of the 1973 war an economic basket case. It was on its way to hyperinflation. financial collapse. The government ultimately nationalized all of its banks that failed. But it wasn't just the war. At that time, Israel was a socialist country. The socialist system, like all socialist systems around the world, was failing. Unlike the other socialist countries that ultimately failed in the late 80s, about 10 years later, Israel's socialist system failed sooner because of the war. The war accelerated many of those trends and pushed Israel over the brink in the 1970s and early 1980s. That is not the Israel of today. Israel had already restructured its economy in the 80s. It had already privatized its socialist industries, state-owned industries in the 90s. It had already enacted pro-competition legislation in the 2000s. It had already upgraded its regulatory system in the mid-2000s. It had already upgraded its laws, injecting more competition into its financial system by the 2010s. My point being that the Israel that walked into the conflict in October 7th of 2023 was a vastly improved economic Israel relative to the Israel of 1973. It was a vastly improved Israel relative to the Second Intifada between 2000 and 2005, and a vastly improved economic Israel that entered the 2006 Second Lebanon War. Despite its current cost, which I really do not want to minimize, I want to put into perspective that Israel economically was better prepared for this situation, even though it was not as well prepared as it should have been militarily. Now, one of the things that I want to emphasize regarding Israel's preparedness is there was a long-term backdrop to how Israel was thinking about military conflict versus its adversaries. And so this chart shows the total number of soldiers in the standing army over the last 30 years, excluding what's going on right now. So on the eve of the war, you will notice Israel, starting in the late 80s, but as the Oslo Accord process accelerated, fooled itself and reduced the total number of people in its army. They began the process of substituting technology for people. Then the Second Intifada changed the equation, but you'll notice that even though they were forced to increase the number of troops during and after the Second Intifada, the total number of troops was still below what it had been before the Oslo Accords. After the Israelis settled the Second Intifada, a degree of complacency returned, and Israel began to reduce the size of its military once again. They reduced the number of months required for service, for example. They began to become a little more lax on who could get an exemption, not just for religious reasons. And as a result, Israel walked into 2023 with a smaller standing army than they had had just a few years earlier, and a substantially smaller army than they had had prior to the Oslo Accords. It's even more striking when we look at it, look at the Israeli military as a percentage of the labor force. Now, why did I choose the labor force? Because that excludes much of the ultra-Orthodox population that is not working anyway, that is not part of the labor force. The Israeli labor force, like the Israeli population, has grown dramatically, but equally dramatic was the shrinkage of the military from about 9% of the labor force back in the late 80s to only about 4.5% of the labor force on the eve of the war. Israel was under the long-term, multi-decade assumption that technology could substitute for soldiers, and they're probably right in many, many ways, but they were very wrong when it came to the overall size of its military. Overnight, when after October 7th, of course, that equation changed in a dramatic and sudden way, pulling 380,000 people out of the labor force directly into the military. And on top of that, we'll talk in a minute about the reduction in labor from foreign workers and Palestinian workers. But overnight, Israel more than doubled the size of its army. And despite over the last year letting many of those people go in order to get the economy moving again, nonetheless, the current size of the Israeli military is substantially larger than it was 1 year ago. On the eve of the war, as you can see, the labor force in Israel stood at 4.5 million people, bigger than the entire population of Israel in 1973, and substantially larger than in the 2006 Lebanon conflict or the Second Intifada. My point here is, despite much of the rhetoric that at least gets passed around in Israel, it's not just that about the ultra-Orthodox not serving in the military. It's about a changed conception that reduced the total manpower that the IDF was drawing. And that conception changed overnight, and I suspect that that will be permanent. Meanwhile, just before the war began, the unemployment rate in Israel was very, very low, only 2.5%. And now it's even lower because of the loss of foreign labor, the mobilization of reserves that continues. And as a result, some of the debate that surrounds the ultra-Orthodox is not just about the size of the military, of course, but it's also about economic growth. Over the last year, there's been substantial volatility in the Israeli labor force. So I want to put that volatility into perspective, once again, comparing it to COVID, because COVID was such a dramatic episode that shut down so much activity overnight. It actually was much larger in terms of its pure impact on the labor force than the current war. Difficult to believe, but nonetheless true. Now, the difference between now and COVID is the duration. Even though the total decline in the labor force was much larger back in 2020 and through 21, it was for a much shorter period of time. This time around, the decline in the labor force was substantial, and so far has only been partially recovered. The numbers I'm showing you now do not show most of 2024. Over the course of this year, especially in the second half of this year, the IDF began to release many reservists that had been called up in the very early days of the war in order to try to get the economy going again, and they succeeded in that regard. On the other hand, they extended the reserve service for many people that were called up, which is where you hear the stories about people spending months on end on reserve duty. So the society is stressed and stretched in ways that it has not been stressed and stretched in many, many decades. Nonetheless, the labor force participation rate has started to recover. Similarly, Oh, sorry, I meant to show a different. Similarly, when we look at total foreign labor, there's been a very substantial reduction. Most of the foreign labor that was involved in agriculture, construction, what have you, left in the early days of the war. And some of that labor has been replaced. The government has made an effort to bring in people from India, China, the Philippines in recent months. Nonetheless, the total labor force has fallen substantially throughout 2024 and only begun to recover in very recent months. One of the good aspects of Israel's financial situation walking into the current conflict was Israel has the highest savings rate in the developed world. We won't get into the weeds today about why that is, but suffice it to say it has to do with the structure of the Israeli pension system. Imagine a 401k in the United States, except for that it's mandatory for all workers and roughly 25% or so of income. You'll now get a sense of why it is that the Israeli savings rate is not only very high, but increasing, combined with the fact that the Israeli government ran a surplus in the year and a half prior to the war. That adds up to a much higher savings rate than in the United States as a percentage of income, which is why Israel has been able thus far to finance this war relatively easily by issuing bonds, mostly to its own people. Let's drill down just for a second on a point I mentioned a minute ago. Foreign labor left, but even more dramatic than the reduction in foreign labor. Like I said, foreign labor, even though there's been a shift in the countries of origin, much of the foreign workforce is starting to come back through various initiatives and programs that Israel has enacted in recent months. What is not returned is the dramatic reduction in Palestinians working in Israel. Now, we don't know exactly how many Palestinians might be working illegally, but the Israeli government data shows that total Palestinian workers have fallen from 200,000 before the war to only 20,000 today, a 90% reduction. Most of those Palestinians, as you'll see in a minute, work in construction. And we'll talk a little bit about the nature of the workforce and whether or not that can be replaced in relatively short order. But before we do, I want to show over the long run what these various rounds of conflict have done to Palestinians. If we look at the percentage of Palestinians in the West Bank and the Gaza Strip working inside of Israel, the peak was back in the 1980s, just before the first Intifada. In the Gaza Strip, almost 40% of the Gazan workforce worked in Israel in the mid to late 1980s before the first Intifada, and about 35% of Palestinians in the West Bank. Starting with the first Intifada, that was the beginning of the disconnection between Israel and Palestinians in a major way. The first Intifada saw a reduction in the labor force, in the percentage of Palestinians working in Israel. But ironically, a more dramatic reduction occurred during the years of the Oslo Accord because of the rise in terrorism. And you might remember, those of you who visited Israel in the 1990s, there were constant closures. That's what the Israelis called them. Closures of the West Bank and the Gaza Strip, preventing Palestinians from working inside Israel because of terrorism and terrorist threats. That saw a dramatic reduction in the percentage of Palestinians working in Israel. Then, when things calmed down a little bit, you saw an increase, only to see a dramatic and somewhat permanent shift downward during the second Intifada, where less than 10% of Palestinian workers were working in Israel in those years. And then as the second Intifada ended, you saw a slow and steady uptick. And one of the irony of ironies was there was a dramatic increase in Palestinians working in Israel in the 2 or 3 years prior to this war. So in many ways, for the first time, the percentage of the Palestinian workforce, I want to emphasize, this is the percentage of the Palestinian population, not the Israeli population. They had 40% of their population working in Israel a generation ago. They were on the cusp of seeing a recovery all the way up to about 15%, and now it's effectively zero. Every single conflict has seen a permanent reduction in the Palestinian workforce, not in its absolute number, but in the percentage of Palestinians working in Israel. At the moment, the disconnection between Palestinian labor and Israel is almost complete. Unfortunately, every one of these rounds of conflict has shot the Palestinians in their own foot from an economic point of view. But it's also created temporary problems in Israel, and it's doing the same right now. Of the Palestinians, 200,000 of them that were working in Israel, 57% of them were working in construction. And Israel has, as I mentioned, trying to bring in foreign workers to handle these jobs because Israel already had a very low unemployment rate. Then you had all the mobilization. It's not as if there are large numbers of Israelis that can shift out of their jobs or military service to go into construction work. Hence, one of the biggest problems in the economy, and frankly for our portfolio, is construction and real estate. The demand is there, the financial capacity is there, the banks are healthy, but the actual workforce to build the projects has been significantly diminished by this war, and it will be replaced most likely by foreign labor, maybe, like you saw in prior conflicts, a small and slow uptick of Palestinians trickling back into the country, but mostly by foreign labor. But that is going to take quite some time to solve that issue. And then in other service occupations, in particular, some in manufacturing, the reduction in the Palestinian workforce has been substantial, but would have been more substantial had they not had multiple rounds of terrorism and closure over the prior generation that led to permanent reductions in Palestinian participation in the Israeli labor force. Finally, let me turn to the stock market. That's what we do here at Israel Investment Advisors. We invest in the Israeli stock market. And of course, this year of conflict has created problems and dislocations in the stock market up until the last several months. Many of you might be surprised to learn that in the last 2 months, since Israel gained the upper hand relative to Hezbollah and successfully took out Iran's air defenses, the Tel Aviv 125 index has surged in the last 2 months by almost 25% just in that 2-month period of time. However, prior to that, things weren't looking so good. And as a result, the Israeli market, when we look at standard valuation parameters, sells at a very substantial discount to the United States and frankly other world markets. And that's reflected in some of the data that I'm showing you here. The price to earnings ratio of the Tel Aviv 125 is about 12. So not quite half of the S&P 500, but pretty darn close. The price to cash flow, meaning the price of a share relative to $1 of cash flow, is half of the US, and enterprise value to cash flow also less than half. For those of you who are not as familiar with these data points, let it suffice to say, Israel is extremely inexpensive, maybe for good reason, but it does appear to be turning the corner militarily, even though economically its problems are still with it in terms of high degrees of mobilization, lowered consumption expenditures, the prospect of higher taxes, the prospect of a larger army, greater defense spending. All of those issues are nonetheless headwinds in the short run. Some of them are probably tailwinds in the long run, such as the increase in defense spending and the necessity of expanding Israel's domestic defense industries. Nonetheless, they are mainly headwinds in the short run, but the Israeli market is probably already looking ahead, beyond the current scenario, maybe even beyond 2025, because it's had a very substantial recovery. And despite that, it still sells at a very substantial discount to the United States and other world markets. Let me end there. I tried to give you an overview of what Israel's financial situation is at the moment relative to what our analysis showed a year ago. Israel has used some of its financial firepower, but it still retains dramatic financial firepower. And that is our message. War has come, but Israel is strong and resilient. Israel has significant financial firepower. Its economic growth is strong. By the way, Israel did grow. Its economy grew over the last year. It did not shrink, not very fast, but it grew. Israel's savings are high, although its debt is now higher than it was. By global standards, it's still quite low. Israel can afford to fight the war and increase the defense spending over the long run, and Israeli stocks are significantly undervalued. Thank you for your attention, and I welcome your questions in the chat and Q&A.
Brian, I have a first question come in.
Okay.
So I'm going to go ahead and start. How has the war affected the shekel?
That's a very good question. Let me start by saying that the shekel, Israel's currency, is quite stable by world standards. If we go back to 2010, when we first started our fund, the value of the shekel today is about the same as it was then, 14 and a half years ago. Now, in the intervening period of time, it's gone up, it's gone down, but it's gone up and down by much less than other global currencies. You might be surprised to learn it's been less volatile than either the euro, the pound, or even the yen, the three other major world currencies besides the dollar. With that said, the Israeli shekel weakened during the period of time in 2023 when the judicial reform debate was in motion, and then it weakened further in the early days of the war. But it never went higher than 4 shekels to the dollar. And at the strongest point we ever experienced a number of years ago, it never was stronger than 3.2. At the moment, it's about 3.6. So the Israeli shekel weakened from peak to trough about 12%, and it has strengthened about 7% since the elimination of Nasrallah. I just want to make one last little comment. These military, associating what's going on with either the shekel or the market, the stock market, with military events is actually rare. In the 14 years that we managed this fund, and in the 30-something years I followed the Israeli market, the only times I can remember security being significantly impactful on the markets was during the Second Intifada and now. So these military developments have been dominant over the last year, but historically speaking, they were not.
Thank you, Brian. Next question. How has the war impacted the Israeli stock market?
Yeah, so that's a great question. So as I said, the Israeli stock markets are complicated animals. So if we go back to 2021, the Israeli stock market was reaching a peak at the same time that the United States stock market was reaching its peak. Then the United States began to raise interest rates, and the United States stock market fell. Israel also raised interest rates for the exact same reasons, coming out of COVID and trying to contain inflation. And as a result, the Israeli stock market fell. Initially, the Israeli stock market and the US stock market fell about the same, about 18, 19%. But then there was an election, and the new government began this judicial reform, we'll call it a crusade. And what really happened, what really transpired is that the Israeli market stayed down and did not recover, even as the United States stock market did in the early part of 2023. Then the war came along. And in the first 3 weeks of the war, the Israeli market fell another 20%. So at its low, the Israeli stock market was almost 40% below its high in late 2021. But then something happened. As soon as Israel went on the offensive in Gaza, the stock market began to recover. And as soon as Israel revealed that it could successfully defend itself from missile attacks from Iran, the market began to go up a little bit more. And by the summer of this year, actually, the market was higher than it had previously been on October 7th, 2023. And then, as I mentioned, maybe the market was up just a little bit less than 7% through September 30th of 2024. But the beeper attack, the elimination of Nasrallah, and what we then came to realize was that basically the total dismantling of Hezbollah, the stock market really began to take off. And then in just recent days, when it became clear that Hezbollah had been weakened so much that they couldn't defend their ally in Syria, the market went up even more. So at the moment, the Israeli market, as measured by the Tel Aviv 125, is, I didn't look actually right before here today, but it's up in the neighborhood of 30% in dollar terms.
Here's a follow-up question to the capital markets. How is Israel's IPO market overall, and in regard to leading companies choosing to list in the US or elsewhere and not at home?
Let me just put up my slide back up. I apologize. I just want to make sure that people have your contact information if they need it, Amy, and our website address. Say that one more time.
So how is Israel's IPO market overall, and in regard to leading companies choosing to list in the US or elsewhere and not at home?
It's dead. It's not doing very well at the moment. Now, part of what's happened is there in 2022, when interest rates went up in the United States, if you remember, we had this post-pandemic bubble. Israel actually participated in that bubble. There was a ton of IPOs back in 2021, but in 2022 that ended. It did not recover in 2023. The United States IPO market started to recover in late 2023 and 2024, but the Israeli market, not yet. So I would say that's the price of the war, that the IPO market has not recovered. The total capital investment inflows, particularly into technology, is actually positive, but lower than it was at that peak in 2021. I just saw data the other day about $10 billion flowed into venture capital in Israel. Well, to put it into perspective, at the absolute peak, it was more than double that. But that 10 billion is still bigger than any year through most of the 2000s. So everything is relative, but yes, there's still a substantial downturn. The IPO market is on ice, and we need it to recover, hopefully, as confidence comes back to the markets, and probably we need valuations to go up a bit. As I showed you, they're quite low.
So I get this question, I'm going to jump one and then go back. As an investor yourself, how has the war affected your investment strategies in Israel?
Well, two things. In the early days of the war, well, let me roll back even more so. We are more conservative investors, so we are not betting on speculative companies. We're not betting on stocks that have a great deal of debt. So as a result, that helps us in every unexpected downturn. The analogy that I often say is the best way to protect yourself from a hurricane is to build a strong house in the first place. That's our approach. However, in the early days of the war, particularly because of the mass mobilization, we did sell companies that we thought might be significantly impacted, either because even though they didn't have high debt, like some of the construction companies, we knew that this could be a very long-term problem if you had really any significant debt. Number two, certain companies that were heavily dependent on consumer spending, we initially sold, some of which we bought back as it became clear that consumer spending was returning. So some of the retailers, for example. So most of the actions that were connected to the war, we took very early on when it became clear the scale and scope of the reserve mobilization required. Now, what I would say is there's been a big rebound in many stocks, including some of the areas that you wouldn't expect, like I mentioned, construction and real estate. So we're trying to evaluate, is that too much hope over reality, for example? So we're going through that right now. We hope construction can improve, but we still think that the labor force problems are with us and will be with the state of Israel for quite some time. The opportunity is definitely there. It's always there. And of course, there's the rebuilding. I'll call it quote unquote opportunity, but construction is going to be big if the labor force problems can be solved. And then finally, defense. The defense sector is going to grow very substantially. Israel, the major defense companies are owned by the government. Israel Aircraft Industries, Rafael are owned by the government. But we own in the portfolio Elbit Systems, which is the other major government defense contractor. So that's another one that we've upped our stake in over the course of this year, because of course, unfortunately, it faces a significant opportunity, not just in Israel, but probably around the world, as Israel has battle-tested many, many systems, sometimes for the first time. Yeah, many of these anti-missile systems, this is the first time they've been fired in combat, and they proved effective. So in any case, that I think is something we're also going to pay attention to in the coming years.
Okay, I think we've covered all the questions. So I'm just gonna mention before Brian closes that we continually go to Israel and we're gonna do an investor trip on March 30th, 2025. So that Sunday will start until the Thursday. And anyone that wants to reach out and join us, please let me know.
Yes, we'd love to show you what we do on the ground when we meet with our companies and get an assessment of what's going on in a very tachlis way, as they say, from an economic perspective. Thank you for joining us. We appreciate your attention over the last hour. And as always, if you have any follow-up questions, please call or email us. You see this number on the screen. And then finally, the research report that we wrote a year ago, we will probably update. When the data becomes available in 2025. I just wanted to show the research report we wrote a year ago. It's still highly relevant, much more detailed than what we went through today. And anybody interested can find it on our website.
I do want to add before we close that we keep hoping for the hostages to return, for the soldiers to come home safe, and for the war to come to an end. Hag Hanukkah Sameach.
Thank you. Thanks for
Bye-bye.
Bye.